Assalamu alaikum, good afternoon, ladies and gentlemen, and welcome to this session on security empowering the digital age, the implications of new demand drivers on the mineral supply. When we talk about security here, we're deliberately using the term more broadly in a strategic sense. It encompasses the defense and national security, but also economic and industrial security. It means to ensure that the minerals required to power both the defense capabilities and the digital economy are available, affordable, and sourced through trusted and resilient supply chains. The digital age is accelerating in an unprecedented pace. AI, cloud computing, electrification, large-scale data centers are driving a surge in demand for a wide range of critical minerals. At the same time, we have the defense priorities evolving rapidly. Modern military systems and advanced manufacturing are all increasingly mineral intensive and deeply reliant on secure supply chains. These demand drivers, ladies and gentlemen, are arriving faster, more concentrated, and more strategically than in previous commodity cycles. Meanwhile, supply chains are under pressure, mining timelines are long, processing capacity is unevenly distributed, ESG expectations are evolving, and geopolitics, of course, increasingly shaping where capital flows and where materials can move. The question is no longer whether demand will grow, but whether the global supply systems are structured to respond in a way that supports both strategic security and sustainable economic growth. Today's panel brings together a producer, an investor, a trader, a digital infrastructure developer, and an expert in policy. Together, we will explore how new demand drivers, namely AI and defense, are reshaping mineral markets, where the real bottlenecks lie, and what will it take in terms of capital, partnerships, and policy to ensure long-term security and actually meet that growing demand. So let me introduce to you my first guest, Professor Morgan Bazilian. He is the director of the Payne Institute of Public Policy at the Colorado School of Mines. Morgan, looking specifically at the defense and military dimension of this, how's the changing geopolitical landscape, which seems it's very quickening since the start of 2026, reshaping demand for critical minerals? And how should governments think about securing that supply for defense needs without distorting civilian markets? We're seeing the Pentagon taking stakes in a number of producers. We just heard Australia announce that it's building a strategic reserves of critical minerals. So how best should they go about this?
Thank you very much, and thank you to the organizers for having me. Good afternoon. In 2008, I wrote a textbook that tried to help define what security means from a mathematical perspective. So taking your introduction, and we looked at 10 or 11 different ways to quantify precisely what we mean about security. So that was in 2008. Almost no one bought or read that book, and which is too bad. But about 10 years later, I worked with the German government around scenarios for what the future looks like for 2100. Of course, we had no idea what the future holds that many decades apart. But what we saw was that these geopolitical tensions that we saw in, say, 2008, and then 10 years later in 2018, and now 8 years later, there remain tensions. There are still winners and losers, and no matter what that scenario looks like. And so that's an important takeaway, that we still have these tensions no matter what the future looks like. And one of the takeaways from the 2008 book is that you can't just define security in terms of supply. And so your question's an excellent one, where we see that you've asked about demand. In between those two things are things like institutions and markets and workforce. And we have security concerns or security risks across that entire suite of things. And so you have to think of security in terms of temporal aspects, in terms of geospatial or geographic aspects, and in terms of courses across supply chains, as has been mentioned many times already. And so taking into account that complex space, what we see now is this, at least in the United States, what we call dual use. That's between the military's demand and a commercial demand. Even at the scale of the US military, which is enormous, they are still not able to influence large markets in a big way, right? And so their focus, the recent financial investments they've made, say in MP materials for rare earths, is in a market that is small enough in terms of trading, in terms of scale, that the military actually can make a difference, at least to their demand, as opposed to the entire commercial space. So lots to focus on there, and exciting topic.
Rajit, you're the CEO of DataVolt. You're a data center developer in Saudi Arabia and the region. From a perspective of a hyperscale data center developer, how materially different is today's demand for minerals compared to previous infrastructure cycles? And what does that imply for long-term supply planning?
Thank you, Naser. Thank you to my fellow panelists as well for having me here. Let me kick it off by maybe addressing a couple of headline themes. The first one that I'll put on the table is, if data is the new oil, in our view, minerals is the engine that's gonna drive it. It's as simple as that, okay? Because we hear too much about data being the new oil, data being the new oil, but no one seems to be talking about the engine of it. And in our view, it's really the minerals which is the engine of it. The second important headline that I would just like to contextualize is what I call the technology supercycle. You know, the minerals and mining business has always been the pioneer in coining the word supercycle, because this is probably one of the most capital-intensive business that the world has seen in the last 50, 60 years in the past. But when you put into context the coming decade and the next couple of decades, the real supercycle is technology. 2023, we saw about $275 billion of capex investment just by the 4 hyperscalers, Meta and the Microsofts and the Googles and so on and so forth. 2024, it was $330 billion. 2025 was $450 billion, just between these 5 companies. And that is a clear testimony of what I call the real tech supercycle. And that tech supercycle needs a lot from the new mineral industry investment going forward. Compute, which is the other name for what everyone calls as artificial intelligence and so on and so forth. Compute power today is requiring at least 5x of what was required in terms of the minerals that traditional compute required. The next 20 years, we are going into what I call the longest supercycle, which is the tech supercycle, and what we will see is the holy trinity of compute. The traditional compute, what everyone talks these days about, the AI compute, and what is still yet to come in a few years from now is the quantum compute. When all of this come, I call it the holy trinity of compute. And that holy trinity of compute requires 5 times to 10 times of what has been traditionally produced. And Now, coming to the second
Yes.
part of your question, very quickly, where do we see the biggest challenges in the context of all of this? It really is in terms of understanding that today, all of these minerals is very localized. There are only very, I would say, localized pools of sourcing and very localized pools of processing. We know that China has been one of the dominant ones in that one.
Yes.
So going forward, the need of the hour is to make sure that we evolve in the whole supply chain, create that resilience to be able to meet that super cycle of compute, which is relying on this.
Brian, you're the chairman CEO of TechMet, and TechMet is a major investor across the supply chain, from extraction, processing, recycling, in a number of metals, in a number of countries. From an investor and strategic point of view, where do you see the most acute systemic risks in critical mineral supply today? Is it resource availability? Is it processing concentration or geopolitical exposure?
I think, there are multiple challenges to transform our industry to the extent that is required in order to meet this escalating growth and demand driven by, as we have heard, AI, defense, the energy transition. And I think one thing that's worth adding very briefly to the AI demand driver, it's not just data centers and energy infrastructure to power data centers. It's the outcome of the next generation of AI in terms of humanoid robotics and drones and autonomous driving systems, all of which are very minor metal intensive. So to change our industry to the extent that's required to produce multiples of present global supply of nickel and cobalt and rare earth metals and tin and vanadium and others is an enormous undertaking, and the constraints are multiple. I think one of the key challenges is price volatility and a market environment in which China has both the ability and the will to manipulate prices and markets to retard competition and maintain overall global dominance over these supply chains. The risk appetite amongst funding providers outside of China and the appreciation of how we manage and mitigate risk in mining and metals is got a very, very long way to go and requires government to de-risk and catalyze that private sector sources of funding of the tens and hundreds of billions of dollars that we need as an industry over the next 5 and 10 years. So those, I think, are key challenges, but they're trade-offs. If we deal a lot with the automakers, and in all cases, they say we want or need preferential access to product to feed our manufacturing programs, and we want those supply chains to not be controlled by our competitors. But we also want them to be price competitive because it's really difficult for us to compete with EVs against the Chinese. And we want the supply chains to be transparent, traceable, and high ESG. And we don't really want to take equity risk in the pipeline because we don't quite understand the risk and value equation. And those things can't be done together. So increasingly, we have to kind of pick our challenges to get the right outcomes, which are secure supply chains, feeding industry without Chinese control.
Mark, you're the CEO of Traxys, a global minerals trader. You link producers to industrial end users. You help sourcing, financing, transporting, and marketing the minerals. How is the role of traders and logistics partners evolving as minerals become more strategic? Are you seeing maybe longer-term contracts, new risk-sharing models, or tighter alignment with producers?
Yeah, I think that's a great question. The first thing I'll say is metals have been strategic a lot longer than the last 3 years that it's on the front page of every paper. The problem is nobody knew they were so critical because they were readily available. The producers, traders had made it so easy for people to get stuff delivered tomorrow that there was a 30-year cycle where people didn't even need to focus on where is my product coming from? Should I be concerned about the availability? And that changed with COVID. COVID was the first disruption of the supply chain. There was dislocation of containers, and people started to run out of stuff. That's been exacerbated by the trade disputes, the quota systems, the tariffs, the restrictions in the traditional flows of product, and now the weaponization of critical minerals and metals is creating a very new dynamic. I think there's an awakening of the consumers of these products to understand that continuity of supply, reliability of supply is increasingly important. And that's causing us to come up with more novel approaches to diversify supply options for customers. And that's why we're going to need to see more longer-term structures that have pricing components that incentivize production expansion. Because capital is not going to form unless there's stability in pricing or some visibility that it's going to be banded in an acceptable range to provide a return on investment.
Michael, you're the president and CEO of Pan American Silver. Silver, of course, which is, just yesterday breached the $90 an ounce. How exposed is the industry to midstream and refining concentration? And does the digital transition materially change that risk profile, in your view?
Yeah, look, absolutely. And I think everybody forgets about silver, really. We talk about rare earth, we talk a lot about copper, which is, of course, incredibly important. But, a great event like this great wall here would not be possible to build without silver, neither your phones, your TVs, your computers, your data centers. So silver is the absolute glue to actually put everything together. While most people think it was been using just for jewelry or a charm around your wrist. Of course, we can make great clean energy with solar panels, but the electronic and the digitalization and electrification of the world absolutely need silver. I think what we also always forget, and the end users forget, is as an industry, we don't really, as a mining industry, and we are one of the world's largest silver producer. In most cases, we don't produce just the metal silver that I can sell. In some mines, we can do that. Some copper mines can do that. But in most cases, we need refining and smelting capacity to do that, which has been really, really centralized in China right now. We don't have these capacities in many other countries anymore. So even if we mine copper in Canada or silver in Peru, at the end, we have to send it to a place where we can actually smelt and produce that metal, which really concentrates it in a very few places. And people really forget about that. The other problem is, I would love to produce it way faster and bring it to the market quicker, but we also had a really undercapitalized exploration industry for probably 20 years. So we didn't find a lot of deposits that we actually can build. And when we find one, it takes, in most cases, 20 to 30 years to get the permits and build that asset before we even can start delivering that to the market. So a lot of complications. It's not just let's go mine a bit faster, we know where the deposits are, but a lot of complications to actually get that refined metal to the end user. And this will be very difficult to undo and distribute it further in the world so that we have that capacity geographically better distributed and available to more end users.
From what I get is that, from what Brian said, from what you're saying, Michael, is that, yes, there might be some bottlenecks midstream, but maybe the more difficult part is the upstream. Brian, you mentioned the tens or hundreds of billions of dollars required. And maybe on capital allocation, I want to come back to you, Mark. From an investment standpoint, how are capital markets pricing geopolitical risk and supply security today, say, compared to 5 years ago? And are the capital markets adequately diverting finance to the industry in response?
Yeah, the short answer is not yet. The capital markets have been broken for the junior miners for 15 years. Capital formation was only available for large, integrated, massive scale projects where you had big balance sheets supporting it and armies of people developing the projects. So we've got a structural problem that's been a long-term issue, and it takes time to rebuild that. I think the price volatility we're seeing today is starting to drive an awareness around the nature and importance of these different products, and the first movers are private capital. So the markets are not functioning, but private investors that are doing the homework are backing projects, and that's essential for stuff to get done. We are now seeing an awakening of government awareness, and the governments are stepping in and supporting projects. And forums like we're experiencing here show the commitment of the Saudi Arabian government to really focus on this critical problem. So I think it's starting to change, but the shorter answer is that the public capital markets are still dysfunctional and have not been fixed yet.
Rajit, what makes Saudi Arabia an attractive platform for large-scale digital infrastructure, and how does the mineral availability here in the country and the energy security for which Saudi is very famous for factor into those decisions?
Look, let me go very clinically on this one now. Saudi, in terms of building the data center infrastructure, there is no place on planet Earth that can beat it. Abundance of land, abundance of energy, but it's just not about the abundance of energy. It is green and it is cheap. We produce at the battery limits of the plants green energy at 1.5 cents per kilowatt hour. People in California pay 40 cents per kilowatt hour. That's the price difference, and it is reliable. Okay? Then in terms of what I call the connectivity, because end of the day, compute is worthless and is a stranded asset if you don't have connectivity. Under the Vision 2030, thanks to the Crown Prince and the Ministry of Communication, they built 17 landing stations in terms of subsea cables. And these 17 landing stations are going up to 24. Another 7 of them are under construction. You can access at a latency of average return latency of 65 milliseconds, almost 55 to 60% of the world's population. You are next door to 1.4 billion people in Africa. You have the 450 million people out there in Europe. You have, through Europe, another 350 million people in the US. You have access to Southeast Asia. That's another close to 2 billion people between India, Pakistan, and Bangladesh. All of them you can serve through this low latency requirement. So long and short of it, from developing that core infrastructure on which you can train your models, on which you can do all the inferencing, which is the heart of AI's evolution, all of that can be done here to deliver what I call the lowest cost of compute. Because the world is starved for all of this compute power, we have not been talking so much about the cost of compute. We have been focusing on the availability, but availability will now shift to affordability. And that's the transition that Saudi will provide by being the third epicenter out here. And in terms of the critical minerals, I already explained, we need a lot of critical minerals.
Yes.
Saudi is gearing up for this. Saudi has access to Africa next door and Central Asia. Outside of Latin America, the 3 epicenters of mining is these 3, and you have access to this too.
Absolutely. Morgan, coming back to policy, and from a policy perspective, how should countries balance efficiency, cost, and resilience when designing critical mineral strategies for the digital economy?
Yeah, thank you. So there's an impression that policy is the optimization of all of those things in some kind of complex mathematical model that gives you this good optimal policy. That's entirely untrue. So policy is almost entirely political. That's the first point. The second is that security is a much stronger driver than almost anything for policy. So politically these days, affordability is in the mindset of the consumers, but security is a stronger driver from politicians and from the political class. That's the second point. What we see in also policy can mean lots of different things, right? So there are policies for regulation of markets. There are policies for financial markets. There are regulations on everything in industrial societies. And so it's very difficult to hone in on one piece of that that's more important than the other. And in the critical mineral space, as we've touched on and other speakers have touched on here today, the issue is that we're using critical minerals as some kind of homogeneous thing, right? But really we're talking about 50 or 100 different things that have different markets, that have different supply chains, that have different consumers, that have different demand, and they interact, right, in this dual use space. And we can see that every day. And so if you optimize the market or policy for copper or steel or silver, you're going to miss what happens with gallium and germanium and indium and the rest of them. And so trying to take all of those things into account, going back to my first point, and I'll end here, is nearly impossible. And so it becomes into a political discussion around what societal priorities are.
Interesting. Brian, coming back to ESG, we've touched a bit upon that. How do you reconcile expectations around ESG performance with the urgency to bring new supply online? Do you think, ESG is getting the shorter end of the stick as we move forward?
Certainly the present pendulum swing is towards security of supply and cost effectiveness of supply, not governance of supply chains, though that is still obviously a very important factor. But it is a trade-off, to build projects cleanly and responsibly in terms of environmental impact and community and political engagement is what we do. And it's enormously important that our supply chains are responsible to underpin the values and economies that we want for our children and grandchildren. But it does cost more and take longer. So there is a trade-off, and that trade-off is a continual balance. What we need in order to do better with that trade-off is innovation. And a lot of what we do in TechMet and our industry needs to do is develop new processes and new technologies to do things quicker and cleaner and better and cheaper in order to change the paradigm to help to transform these supply chains.
Michael, given the growing geopolitical competition over these critical minerals, are producers really still under pressure to meet ESG expectations?
Oh, yeah, absolutely, and I think we should. I mean, there's different ways to produce these metals, and they're very responsible and clean ways to produce these metals, and that's what we should try to achieve. We're all going to have children and grandchildren, etc. We cannot just go one way. We have to do this the right way. That's absolutely possible. For me, ESG is not just a box-ticking exercise. It's really what happens in the field, what happens in the countries and communities we're working in, and how we behave and work with those groups. That's way more important to me than somebody ticking a box in an office in London or Zurich, trying to range, from 1 to 10 a company. So that's really important. But don't forget, if you talk about here regulatory issues, policies, at the end we have to go where the deposits are, right? The mineral deposits are not evenly distributed in the world. We have to go where the geology put them and then deal with the situation there. So geopolitical risks are real. We cannot just get around. We cannot just move to another country. So we have to absolutely work with the right way with the communities and in our host countries to be able to produce those metals and help not only the companies that come in and the countries, but also communities that live around them.
Well, that's all the time we have, but before we leave, Michael, I'm sure everybody wants to know what's the new direction for silver prices after $90 an ounce. I mean, how much of it is market speculation, financial short squeeze, and how much of it is really fundamental?
Well, it's about 60% is used in industrial applications. So there's a base price, which is for sure somewhere maybe around $50 or more. So just right now, we just heard that we're going to need way more silver in the future, so that's going to climb up. About 25% of the market goes in jewelry. That actually increases when gold prices go up. Everybody likes jewelry, so we go move to silver. That leaves very, very little silver for speculation, investor, bullions, you name it. I think it just hits $92 silver just the time we were sitting here. It's probably up another dollar. So I'll not be surprised if we see, a high three-digit number here pretty soon. So I'm obviously very bullish on silver, but I think what you heard today here, there's so much demand that's coming down the pipe.
Yeah.
For sure that demand will increase in the future.
And you're a happy man at the start of 2026. Thank you, gents, and thank you to the audience for listening in.
Thank you very much.
Thank you very much.